Welcome back. Today I've got an interesting idea on the fear of missing out relating to the recent hype and rally that we've seen, where we have seen many stocks go up double digits in the last week. Lately I've been trying to increase the value that I'm adding to my videos, so if you think this is an exceptionally high value video compared to my rest, then please drop one of these to help beat that YouTube algorithm, as it is much appreciated. So as we can see in the markets at the moment, stocks are up massively. We can look at the S&P 500 heat map here for 1 week, and you can see a lot of significant movers. You've got Google up 12.6%, Amazon up 8.21%, Meta itself up 25.82%, even the largest company is up 5.75%. So we've seen some big swings in the market. And what's really driven this? Well, this is the US CPI print. Now, they had expected, or I think analyst views were sitting on around about 8 and a bit percent. However, CPI had come through, and actually it was at 7.7%. This was better than expected news, and therefore the market saw a bit of a relief rally here. However, this hasn't really changed things overall, as it's still very likely to look like we're going into a recession, and inflation is still extremely high. An inflation rate of 7.7% is still a very high figure indeed, and furthermore, when driven down into this, has actually still been a month-on-month increase. So inflation is still pushing upwards slightly, and it's still not good news yet, as it still needs to come down a long way. That said, rightly so, I do believe that stocks had been pricing in a negative future, and the stock market always thinks in advance, 6-12 months in advance, right? So I do understand there is a relief rally now, because ideally, in 12 months time, we're going to see a lot of inflation behind us, or at least that's the hope in the markets. However, we've seen such a huge move in these stocks, even the UK stocks themselves, that one might question if the likes of obviously consumer services stocks in the UK going up by nearly 8% in 1 week, retail trade going up 6% in 1 week, if this is a sustainable gain. After all, the average return of the S&P 500 over a 30-year period is 8% per year on average. This is an average figure, of course. Now, we're seeing this in a week, in a couple of days. Amazon, one of the days, I think it was Thursday on the day of the CPI print, was up 12%. So obviously we have got some big movers in the markets, and right now a lot of people might be going, or there's going to be two sides of the spectrum. You've got a lot of people that are currently very pessimistic, right? They're like, no, the market is a bear trap, right? It's a bull trap, sorry. The stock's going up, but they're going to come back down ultimately because it's still bad news. But then there's also a lot of optimists. They're like, now's the time to buy. This is a good time to buy. But actually, when you look at the net inflows of capital into the markets, they've not really increased. So it looks like it could be a lot of short covering. And one of my holdings in the portfolio, Boohoo, is the highest percentage shorted stock in the UK. So it's no surprise that they have seen a significant rally as well. When we look at my portfolio, I'm up 20% for the week, which is no formidable feat by all means. That is very, very, very strong. Now, I'm not going to celebrate here because, again, I'm not going to let my emotions get to me. And at the same time, I think, obviously, there's going to be room for a correction here. I ideally prefer stocks that are able to grow sustainably over the longer term, but because they're growing at a consistent rate, this means they bring back longer overall returns. Now, when you see a stock climb by 20% in a week, this is obviously a little bit of a negative, because is it sustainable? And yes, don't get me wrong, I do think Boohoo is at such a low price point that this is kind of to be anticipated, or it's easy to say in hindsight, but the short percentage was so high as well that we really need to watch to see if this is reduced much, because this just could be the shorts being covered as per mentioned. Now we're looking at Boohoo, where they're sitting at about 56 pence a share, right? I'm now only down 47% overall in my portfolio. I think a week ago I was down about 56%. It goes to show that things can move very quickly. And in this time period, as I said before, it's very important not to let your emotions get the power of you, right? I'm going to be looking at fear of missing out here, right? I've just seen my stocks climb. Boohoo is up 11% for the week, right? Should I be buying more? Well, currently, right, Boohoo is sitting at 56 pence a share. My average is £1.25. So therefore, I'm still underneath my average. I should be buying now because the stock's going up now. I need to be buying. And this is a very evil cycle. We've got to be cautious here. At the same time, on the other side of the spectrum, the pessimistic people, those who are outside of the markets holding cash, might be going, or might be in denial right now, going, no, this isn't recovery. This is just going to drop again. And those people that are sat in cash are currently facing inflation of nearly 8%. In the UK, I believe it was 10%, right? So if your cash is losing its value over time, interest rates are 3-4%, right? It's not enough. So you got your cash outside the markets and your stocks that are going up. People, obviously, you don't know what to do. Do you now invest where the stocks are climbing rapidly, or do you sit it out a bit? In my eyes, typically dollar cost averaging would be the option here, right? As soon as or as frequently as you get paid, deposit that money into the markets, automatically buy these stocks and remove that human element from it. Now, this is great in an index fund portfolio. However, when you're on about individual stocks and shares, you do have to do more research into it and decide what company has the best value. And until I can personally do the price targets, which is what I've been talking about in the last few videos, I'm not buying anything as of yet. I've got a cash position of 3.9%, and that's going to sit there for now. I'm going to build that up potentially until I can find an appropriate way of valuing my companies and identifying a price target. I'm not buying, simply because I'm unable to, right? I don't have the capabilities to identify a price target, so therefore I shouldn't be buying. And that way, I'm at least going to be sat out for the period of this. And you know what? Look, so what? If Boohoo now climbs to 80 pence a share, and I had the opportunity right now to buy more shares at 56 pence each, great. Well, I lost out on maybe, 4% of the cash I could have put into position of gains. Okay, that sucks, but at the same time, I've got 20,000 shares. I am getting some of the return on this, and I need to think of this in that way too. So do we like keep buying here or hold cash? And again, that's down to the individual investor. I'm personally got a majority of my net worth invested in the stock market already, so therefore I'm comfortable holding a little amount of cash or building up cash reserves now as the market seems to have a bit of a relief rally. After all, it does seem to have an overall negative outlook in the future, so perhaps we could be floating around or being in a sideways market for the time being. That said though, there does seem more positive outlook for a year's time. It does seem that obviously all of these like shipping issues, logistics could be easing up a bit here. Costs are reducing, energy costs are reducing as well. It could seem like a positive outlook on the economy. And as I say, the stock market's forward thinking, right? So this may have been the low a few months ago or a month ago. But that said, we don't know this for sure because we don't have a crystal ball and I can't tell you exactly when the bottom is. So I guess the best thing is to keep investing, right? But do we wait for the market to try and cool off but miss out on these potential gains, as I've mentioned? Like, do we say, right, look, Boohoo, I want to buy at 50 pence a share, but you keep seeing it go up and up and up. When do you sit there and go, you know what, look, my shares have gone up to a high enough value now. I'm a little concerned. Have I done my valuations properly? Because they continue to go up. Like, you're going to end up psyching yourself out of investing. So it's very, very important perhaps to remain detached from the markets, especially in a time like now where volatility is rife. I personally feel that if you have got more than 80% of your portfolio invested in the stock market, maybe just chill out for a bit. Research, read the reports, but don't look at the stock prices. I found myself prone to a form of anxiety because I'm looking at Boohoo and I'm going, wow, they're up 15% today. And then I'm getting distracted by it. I'm constantly thinking about it. And then, oh no, it's down 13%. Damn, it's down 13%. Sorry, it's only up 13%. This is outrageous. It was up 15% earlier. Where are my gains? And obviously, you're only thinking about that because it's such a high number. And again, it's like the way you get your dopamine. So if you avoid looking at your shares all the time, if you're opening your fucking share, or your Yahoo Finance every 10 minutes, or you're refreshing your share prices on a minute basis, it's not a good thing. You're just going to end up distracting yourself. You're not going to get any productive work done. And you're going to be so prone to your emotions that you're going to see Boohoo rise by 4% and go, I need to take a quick profit here. When in reality, the best thing you can do is invest for the longer term. Have a fantastic day.